Hey everyone, welcome back to the Noob Selling Options channel. I am absolutely thrilled to have you here for today's explainer. We're going to talk about something every single option seller eventually faces, but let's be honest, rarely wants to discuss: survival. Specifically, we're breaking down how to survive a violently tested short call when the market just completely turns against your position. If you've ever watched a stock absolutely rip through your strike price and felt that pit in your stomach, well, this explainer is definitely for you. We're going to look really closely at my exact move on the SNDK strangle from yesterday. We're pulling back the curtain on the math behind it, the strategy of why I only rolled the call side, and the psychology you absolutely need to stay alive in this game.
All right, here's our roadmap for today. We'll hit number 1, the SNDK adjustment, 2, the exact math of the roll, 3, how to avoid the whipsaw trap, and 4, the psychology of survival. Let's get right into it. Section 1, the SNDK strangle adjustment. So, how exactly do we navigate this surging AI demand? Look, we've got to first address the elephant in the room regarding this trade. SNDK has been on an absolute tear, blasting deep past the 1550 range. And why is this happening? It's being completely driven by this massive enterprise solid-state drive demand for AI data centers. I mean, the demand has just gone into overdrive, and the stock is reacting. Now, when a stock surges violently like that, the short call side of your strangle inevitably comes under some incredibly heavy pressure. You see, when you sell a strangle, you're trying to define a nice, comfortable range. But when massive secular trends like AI hardware grab hold of a stock, it doesn't just casually drift past your strike, it blows right through it. This intense delta risk, the immediate threat of that surging stock price working against us, forces us out of our standard routine and straight into calculated survival mode. You can't just freeze up and hope the stock comes back down. You actually have to take action. Moving on to Section 2, the math of the roll. Let's look at the exact numbers and see how we calculate this defensive debit. I love this part because we're being radically transparent here. What you're looking at is my real-world brokerage screenshot showing the exact execution of yesterday's adjustment on the BATS exchange. We rolled this all the way out to the February 19, 2027 expiration. Just notice the sheer size of the premium on these long-dated contracts, or LEAPs, which basically buy us years of time value. We aren't dealing in hypotheticals today, folks. We're looking at real, live execution. Let's break down the exact math. Step 1 was neutralizing that immediate threat. We bought to close the original 2100 strike call, which cost $441.39 per share. That means a massive outflow of $44,139. But simultaneously, step 2 was selling to open the new 2300 strike call, pushed further out of the money at $398.39 per share. That brought in $39,839. So step 3, when you net those two giant figures together, it leaves us with a net debit of exactly $4,300. That's what was paid out of pocket to adjust this leg. Now here's the absolute crucial point. That $4,300 net debit, it wasn't just money thrown into a fire. No way. This $4,300 essentially bought us an additional 200 points of strike price distance. And since options contracts represent 100 shares, those 200 points literally equate to $20,000 in nominal value of much-needed upside runway. We drastically reduced our immediate risk and pushed our upside break-even significantly higher. We basically gave the stock a massive new runway before our short call gets dangerously tested again. All right, Section 3, avoiding the whipsaw trap. Let's talk about exactly why we defied the textbook here. This brilliantly illustrates the difference between blindly following generic rules and making a smart, context-aware directional play. If you pick up any options trading manual, the textbook mechanical defense for a tested strangle is to roll the untested side, in this case the put, closer to the money to collect more premium. The theory is, hey, this new premium helps finance the $4,300 debit we just dropped on the call roll. But guess what? We didn't do that. We made the discretionary call to leave the put entirely alone to contain our downside risk. We deliberately defied the textbook to avoid getting trapped. And you might be wondering, why? Well, because we suspect SNDK is going to U-turn and cool off pretty soon. Actually, rolling the put up right now would have been a dangerous trap. If we had rolled that put to a higher strike just to grab some premium, we would have drastically raised our downside risk. Think about it. When the pullback we're anticipating actually happens, that higher strike put could quickly get tested on the way down, catching the portfolio in a brutal, account-destroying whipsaw. By leaving the put exactly where it is, we kept our downside risk comfortably contained while successfully relieving all that immediate upside pressure. Finally, Section 4, the psychology of survival. This is all about maintaining that multi-year focus.
Okay, let's transition from the hardcore math into what I think is the emotional climax of this explainer: how to reframe a realized loss into a masterclass on multi-year survival. Look, navigating high-conviction tech portfolios requires a profound mental shift. You have to move away from needing to win a single localized trade and focus on needing to survive the entire market cycle. We do that through 4 key pillars. First up, detaching your ego from the P&L. The default human reaction is, I can't close this for a loss. I need to be right. But that just leads to paralysis. Taking a proactive debit takes real discipline and ego detachment. Second, treating the debit as a business expense. Selling options as a business, and risk management, that's just your overhead. Third, preventing the revenge trade spiral. Refusing to take a temporary negative often leads to dangerous over-adjustments, like aggressively rolling that put up, which, as we discussed, we totally avoided. And fourth, the power of staying at the table. This means prioritizing capital preservation above literally everything else.
Let's compare 2 totally different ways of looking at yesterday's trade. The amateur mindset looks at the account and views that $4,300 debit as money burned, a complete failure. But the survival mindset? It views that exact same $4,300 as a necessary insurance premium. When you zoom out and look at long-term wealth milestones set for, say, 2022, you realize this localized adjustment in 2026 is just a microscopic blip. It's an insurance premium we gladly paid to buy $20,000 of breathing room and keep our core portfolio entirely safe from margin calls or assignment risk. There's a core truth you really need to let sink in here. A temporary negative keeps your capital deployed, your positions active, and your chips on the table. In high-conviction tech investing, those outsized returns come from exponential secular trends. If you get wiped out during a violent short-term rally just because your ego wouldn't let you realize a $4,300 loss, you completely miss out on the decade-long compounding. Taking a tactical hit to live another day allows you to stay at the table. You can always chip away at that debit over the coming months by selling shorter-term options against it, but you can only do that if your account is actually alive tomorrow. So I'll leave you with this final thought. Are you going to let the fear of a localized loss keep you from decade-long compounding, or will you pay the insurance premium to survive? Remember, surviving the market cycle is the ultimate goal. If you found this breakdown of yesterday's 4.3K defense helpful, please smash that like button and subscribe to the Noob Selling Options channel. We are building an amazing community of disciplined traders here, and subscribing ensures you'll keep learning these crucial survival tactics that'll keep your account alive and thriving for tomorrow's trades. Thanks so much for watching, and I'll see you in the next explainer.